Aloha, this is Kurt Nielsen with eMortgage Hawaii, and this is my annual outlook for 2018 for the Hawaii mortgage and housing market. So we're going to start off by talking about some of the dynamics in 2018. There's a lot going on. The first thing are the Tax Cuts and Jobs Act of 2018. We're going to talk about how this is going to affect housing. Also, is there a possible stock market pullback? We believe so, and we want to talk about how that's going to affect housing and interest rates. And also, we have a whole new Fed. They're presently indicating 3 rate hikes, and they are scheduled to further unwind their balance sheet of mortgage-backed securities. So what's that going to do to mortgage rates? We know that rates are really set to rise in the year ahead. We're going to talk about how much we think they're going to rise and what the impact is going to be on the housing market. And finally, can housing really continue the impressive run it's had? And will the tax reform be a drag on the housing market? Okay, so let's get started with the new tax reform, the Tax Cuts and Jobs Act of 2017. So the most important things that affect housing and mortgage rates is that they have dropped the mortgage interest deduction from a $1 million loan to a $750,000 loan. So you can only deduct the interest on up to $750,000. And really, this is not going to impact the vast majority of home buyers, and I don't think it'll have any impact on dissuading luxury home buyers from buying a luxury home. It's only interest on $250,000 for the rich, and I don't think that's going to keep them from buying homes. We did keep the capital gains on home appreciation. That didn't change. Again, you have to live in a house for 2 years out of the last 5 years to get the exemption on the gain on home appreciation. This is a big one. The standard deduction is increased significantly for all tax filers. So we believe that that's going to reduce people itemizing on their tax filings from about 49 million taxpayers to only about 10 million taxpayers. That's 4 or 5% of the U.S. population are actually going to file an itemized tax return. So in effect, mortgage interest deduction, property tax deductions, they really aren't going to have a major impact on the housing market, just because most tax filers are not going to file an itemized tax return. One big portion of that is the fact that they're going to limit the state and local income tax and property tax deductions to $10,000. So again, for most Americans, that's not a big deal, but in the high-priced and high-taxed states like California, New York, New Jersey, they're going to be impacted. Now, this is a big one. I wasn't talked about very much, but the interest deduction on home equity lines of credit have been eliminated. So you may want to refinance into a new first mortgage if you do have a home equity line of credit. And the fact that the feds are going to be raising interest rates directly affects home equity lines of credit. So those interest rates are going to be going up, and it's no longer tax deductible. So we believe that housing will largely be unaffected by the tax changes, and certainly mortgage rates, there shouldn't be any effect from the new tax changes. There is one big thing that will affect household income, and that is the fact that corporate tax rates have dropped from 39% to 21% and to 15.5% on repatriated foreign income. That possibly could result in corporations making larger investments in manufacturing in the United States. Hopefully that'll create jobs, and hopefully that will raise income. Okay, let's talk about the stock market. Right now we think that the stocks appear very toppy and vulnerable to a pullback. We are entering this new year with extremely high investor optimism, and this is often a dangerous sign. When everybody's enthusiastic, everybody's buying stocks, some of the institutional investors start pulling out, and you have a pullback in the stock market. Even if there is a pullback, we don't think it's going to be huge, but we do see a pullback. Right now, we have the most expensive stock market on a price to sales ratio ever. Now, granted, those sales are more profitable than they used to be, and price to earnings ratios aren't quite as high as the price to sales ratio, but it's still extremely high. For us to maintain this stock market, we're going to have to see a boost in corporate earnings. Part of that's going to come from the tax rate cut, but I don't think enough to keep a correction from happening. The impact on stock prices due to the corporate tax cut and the repatriated foreign income tax cut, it may delay the stock pullback, but I don't think it's going to stop it. And remember, this is the third longest stretch of expansion in U.S. history. So at some point, you are going to have somewhat of correction. The other thing that we have to watch for is we have a flattening yield curve. I'm going to talk about that here in a minute. So this is the price to earnings, price to sales ratio, and we've hit the all-time high. Again, we've had some analysts point out that yes, but in terms of earnings, those sales are generating more profit, so you should pay more for it. And granted that's true, but is it enough to keep the stock market from pulling back? Probably not. This is one thing we do watch, is the yield curve between the 10-year Treasury and the 2-year Treasury. When the 2-year Treasury is providing the same or a higher interest rate than the 10-year Treasury, we call that an inverted yield curve. And every time we've had an inverted yield curve, we've had a small recession at least. Inverted yield curve, recession, inverted yield curve, recession, inverted yield curve, recession. It doesn't happen immediately, it could be a year down the road, but if we do see us drop into an inverted yield curve, that might mean, and has in the past, that a correction is coming in the economy. Now again, the big unknown is this tax cut for corporate tax rates. How is that going to play into jobs markets, reinvesting in our economy? It could prolong this run, so we're not too sure exactly how that's going to turn out. But again, we think that there is going to be a stock pullback during 2018 after such a big 2017. You might see a 5 to 10% correction, and it might be a good time for people to diversify out of their equities into housing because we do not see a slowdown in the appreciation of housing. Another big issue that we have to watch for is the changing of the guard and the Fed. The President Trump may be electing 4 new board of governors. So it's going to be a big change in the Fed. Most likely these are going to be more hawkish governors, not as dovish as in the past. So that would mean that there would be continued tightening and again a progression of them pulling out of the mortgage-backed securities market. We're going to talk more about that. The Fed members are forecasting 3 rate hikes. We don't think it's going to be that many, and certainly the most would be 3 rate hikes. So that would increase prime lending about 0.75% this coming year. This is the important thing right here, is the Fed currently is the largest purchasers of mortgage-backed securities. As you can see, prior to October, they were acquiring $25 billion of mortgage-backed securities every month. In October, they agreed to lower that by $4 billion to 21, and then every quarter they're going to reduce by another $4 billion. So by the end of 2018, in December of 2018, they'll drop from $5 billion down to 0. So in 12 months' time from today, the largest purchaser of mortgage-backed securities will be gone out of the market. It has to be replaced by private investors, either pension funds, foreign governments. Somebody has to replace that. To replace that, that normally means you have to offer a higher interest rate or rate of return, which directly affects the interest rate that we get on our mortgages. So this is what's been keeping mortgage rates down, and it's coming to an end in less than 12 months. So in 12 months, we should get back to a normal mortgage-backed securities market, and have more normal mortgage rates. This is the Fed's balance sheet on mortgage-backed securities. Right now, they are holding about $1.8 trillion worth of mortgage-backed securities. At the end of 2018, they'll be out of repurchasing mortgages, and then they're just going to let those mortgages pay off and drain off their balance sheet. Now, just the normal course of people refinancing, moving, selling their property, those mortgages get paid off. So the Fed won't have to go out and sell mortgages or mortgage-backed securities. They just stop purchasing, and the natural course of people moving and people refinancing and people selling, those mortgages will get paid off probably by about 2025. So in 7 or 8 years, we see the Fed's balance sheet dropping off all mortgage-backed securities. That would be a good thing. Our prediction is that the Fed will probably see 1 to 2 rate hikes, especially if the stock market does pull back somewhat. So the first 2 rate hikes will probably be in the first half of the year, and then we may see a stock pullback, and then maybe the Fed's backing off on any further rate hikes. Okay, rates for mortgages. We're going to talk about our forecast. As most people know, mortgage rates are really driven by inflation. We do not see inflation rising very fast this year, and it should be very tame. So rates will move higher, but not too bad. The Fed quantitative tightening, this is going to drive rates up. There's no way that we can maintain our current interest rates if the Fed gets completely out of the mortgage-backed securities market by the end of 2018. A stock pullback could actually help rates, because if money leaves the stock market, it tends to go into the bond market, both for treasuries, mortgage-backed securities, and other low-risk investments. So our prediction is that the 10-year treasury note will probably trade between 218 and 264 for much of the year. We do see mortgage rates going up about 3/8% higher on average. A lot of this has to depend on what happens in the stock market. If the stock market does not pull back, you might see this at 3/4 of a point higher than it is today. So you'll be over 4.5%, under 5% on a 30-year fixed. And so we also think that adjustable rate mortgages will come back and gain a larger share of the market. And that's the way it should be. You know, remember, you go to Canada, you can't get a 30-year fixed rate mortgage. They don't even offer it. So every 5 years, you get a new rate on your mortgage. And that's the way the most of the world is. So adjustable rate mortgages are kind of typical. They used to account for more than half of all the mortgages originated in the United States. And what's happening is people are getting 30-year fixed mortgages. They're paying for something they're not really using, because they don't keep the mortgage for 30 years. And the banks are getting a windfall profit because they're getting that higher interest rate, knowing that the average mortgage pays off in 5 to 7 years. So, you know, again, I think adjustable rate mortgages are smart, especially for younger people. Maybe not so much for people retiring that want to keep that mortgage rate fixed, you know, during retirement. But for younger people in their higher income earning years, it's a good deal. Okay, so we're going to finish up and talk about housing. We don't see housing changing any. There is low inventory. New home construction is not meeting the demand and growth. So we still think housing is going to remain tight through 2018 and probably through 2019. Rents are rising at 4% a year, so it's going to drive more and more buyers into housing. We don't think the rates are going to affect or derail the housing market, especially since, you know, you can move into a 7-year ARM and still stay at below 4%, probably all the way throughout 2018. You'll stay below 4% on a adjustable rate mortgage, so that will help us maintain you know, buyers in the housing market. And again, demand is remaining strong because, hey, wages are rising. I think 2.5% nationwide this last year. So, and that could stay that way because of the lower corporate tax rate. A lot of companies already announced bonuses and wage increases due to the tax cuts. So if that continues, then we might see um, a continued growth in wages, and we only need about a 1.5% rise in wages to maintain about a 4.5 to 5% rise in home appreciation. The tax implications on real estate, we just don't see the effect. It'll affect the real estate really whatsoever. The 2-year, capital gains exclusion, if you stay in your home for 2 years, that still remains in effect. And the doubling of the standard deduction, it really didn't double, but close. Will keep filers on from itemized, using an itemized deduction just to 4 or 5% of all the filers. So I just don't think the tax changes are going to affect real estate whatsoever. So we are predicting for most of the state of Hawaii a 4.5 to 5.5% appreciation, which is where we were last year and pretty much what happened. There are some spots with less and some spots with more, but on average, the state of Hawaii did increase about 5% last year. And I just want to leave you with something that Albert Einstein said, that compound interest is the 8th wonder of the world. He who understands it earns it, and he who doesn't pays it. I saw an analysis from a university professor that said that renting was just as good or better than buying a house. He's flat out wrong, and I'm going to have a YouTube video on that. But if you have just a 4.5% annual rate of return on home appreciation on a $500,000 home, in 10 years that home goes up to $776,000, and you have gained $276,000 in equity, plus the reduction in the mortgage balance on top of that. That's the amount of equity you'd have in your home. So for those that don't own, they're missing out on really the best way to increase your net worth for the average American. And this really needs to be passed on to your clients that are looking at, there might be a first-time home buyer or they're afraid of the market. And remember, for the last 50 years, home appreciation has averaged 4.5% per year for the last 50 years. So you have some ups and down years, but on average, you gain about 4.5% a year. Okay, that's it for our presentation. I look forward to hearing from you, and have a great 2018.